Alternative investments provide options beyond traditional stocks, bonds, and cash, aiming for diversification and potential growth. These assets include private equity, hedge funds, real estate, commodities, and collectibles, each carrying unique risk and return profiles. Private equity involves direct investments in private companies, often targeting long-term value creation through strategic management. Hedge funds, meanwhile, use diverse strategies such as long-short equity and derivatives to generate active returns. Real estate investments range from residential and commercial properties to real estate investment trusts. Commodities, including gold and oil, offer inflation protection, while collectibles like art and rare coins may appreciate over time. These assets can reduce portfolio volatility due to their low correlation with traditional markets. However, many alternative investments involve lower liquidity and higher minimum investment thresholds, often appealing to institutional and high net worth investors. Recent innovations, however, are making them increasingly available to retail investors seeking growth and stability beyond conventional assets.
Teresa, I want to start with you. Many experts say that we're living longer, so we need to work longer to save more for retirement. What's your view on the retirement crisis today?
Well, we have a retirement crisis, and a lot of it is because we've had this experiment for 40 years where American individuals have been asked to shoulder the risk of the market risk, the systemic risk, their own risk of making a portfolio allocation mistake, of their own risk of actually being out of the labor market for a while. It's an inappropriate shift in risk, and it didn't work. It's a failure. We've had a generation of workers living under this experiment, and we now have the results of it. The median amount of retirement assets to supplement Social Security is zero. If we conditional on people having a retirement having a retirement account, the median amount is $90,000, which is kind of a dinner in a movie, once a month for the rest of your life. It's not anywhere near adequate, and it's because we've have this do-it-yourself system where people individually direct their portfolios. So I'm very worried about these new asset classes in individual portfolios.
Interesting. Shana, as the queen of alternatives, can you explain how retirees and their advisors can include alternatives in a portfolio construction?
Sure. So I'm going to start off by addressing what I think are going to be the vast majority of the concerns from the other panelists, which is the lack of transparency, the lack of liquidity, the complexity of these types of products, and are they suitable for the average investor? And my answer to that is it depends. So if you look at alternatives broadly speaking, I like to say there are diversifying alternatives, and then there are just alternative ways to get access to traditional areas. So private equity and private credit are still equity and credit, and they have the same risk associated with them, whether or not that traditional equity markets have. Just because they don't have to mark to market doesn't mean that if they had to sell during times of stress, that they wouldn't experience similar drawdowns. And they should be considered as part of your equity or credit portfolios. Now, the benefits, of course, to these types of strategies is that by being in a less efficient private market, you have the better opportunity for alpha creation. But the average person who doesn't have sufficient retirement savings probably isn't even eligible for these products in the way that they have historically been offered. There's been a change in the market where we have this idea of this democratization of these products. And more we're seeing strategies come to market in packages that are available to any investor. So things like interval funds, which is a fairly new innovation. I mean, the interval fund is not new, but the more broad use of it in the alternative space is. But they still have similar issues as it pertains to liquidity and ability to get access to your funds in time of need. But I do think from a retirement perspective, The benefits that alts really play is in the risk management as a risk tool. And I'm sure there are plenty of people on this panel that would disagree with me, but I can firmly say with a lot of conviction, because I wrote the module for it for the Kaya Association, that the actual research supports the fact that alts are diversifying to portfolios, allowing for you to, as an investor, to take risk in places that make more sense. And the diversifying alts are things like hedge funds and things that are not related to equity or credit. So things like collectibles, sports, things of that nature fall into that diversifying bucket. And research shows that about a 20% allocation to that, usually coming out of fixed income, because a lot of these things do actually generate substantial cash flow, sometimes even better than fixed income. They can support your income needs in retirement, but at the same time provide you a diversification benefit. So the ride is smoother, because at the end of the day, the portfolio that works best is the one you can stick with. And when you have less volatility as a whole, and some of it, I will firmly admit, is somewhat of a charade in that they don't have to market all the time. But psychologically, from a client perspective, that doesn't really matter. It really is about smoothing out the ride to make the portfolio that they're in positioned better for them to stick with it to help them meet their end goal in retirement.
Well, I think that's what's important. And I think it gets interesting because access is increasing. I'm seeing more ETFs where they're actively managed strategies. There are different hedge fund managers who are launching ETFs because they want more distribution. Roger, just because you can doesn't mean you should.
I think that's the point, and you have to approach this by what are you trying to solve for first? If you are at retirement, you're trying to solve to meet the liabilities of your spending over a period of time. You're not trying to solve for alpha, as an example. And an important thing to understand when we're talking about alternatives is that, a quote from my favorite economist, which is, there are no solutions, there are only trade-offs. And it's important to make your retirement plan as simple as process. Now, in terms of the increase in access to alternatives and it going down market from a net worth standpoint, after 30 years in this business, it's just really marketing. Nobody's asking for this. It's a distribution. We have new ways that are legal to distribute products that are more sophisticated. And it's always about grabbing assets from a product manufacturing standpoint. That is just the nature of the system, not good or bad. As someone trying to actually solve for their retirement plan, it's important to know, is it worth the extra complexity and execution risk to add it to the portfolio? And most of the times it really isn't. Now, this is a very different issue than what Teresa was sharing, which is a major issue. Most people just don't have the money to retire for a variety of reasons. I do agree that it is a part of the transition from pension to 401k, but I think it's much more multidimensional in that you can factor in consumerism and debt and our community, our consumer society to contribute to that as well. But I think it's a tool in the toolbox, but a much more complicated one that needs to be used very carefully.
I do want to just interrupt, if you don't mind, to address the comments about going down market and being an asset grab. To some extent, that's true. But there's also a very overwhelming demand. We see it all the time in the RIA market. Clients are asking for this. There are a couple of things that you'll see in generational evolutions right now. So if you take out the baby boomers who are in retirement and you think about the generations behind them, those generations want to invest in a way that aligns with their personal values and passions, and traditional investments don't necessarily do that. Really, it's only the alt space that allows for that. By having more liquid and more accessibility to it, advisors can provide their clients with things that they are more excited about, that work for the portfolio. And I will note that if you were to look at, I used to work at Mercer, and I worked in the whole idea of doing liability-driven investing, LDI. Most LDI models stay out of equities and really focus heavily on the whole goal is to have just fixed income meet the liabilities of your portfolio. In order to do that, you have to have a risk budget, and you have to stick with that risk budget. And then as you get closer to being able to meet your liabilities with the least amount of risk, you take the risk down. By adding alternatives into a portfolio, that actually reduces the overall risk of not being able to meet your liabilities. Now, I will also say that, yes, they are complex. But they don't have to be. I think as an industry, we treat investors and their advisors a little bit in a condescending way, as if they're not smart enough to figure this stuff out, and don't give them the information they need to actually learn.
I actually disagree with so much of what you said, Shana, in terms of consumers asking for it. And I think it's probably more advisors asking for it as a means of telling a story to a client. And within the context of in retirement planning, there are very few retirement planning advisors. There are a lot of advisors that were trained via CFP and the normal certifications on accumulation. And now that they're approaching clients that are in retirement, they're thinking from an asset allocation optimization mindset, which is a strategy that was never intended for decumulation. And so the process they're using to try to generate alpha or manage asset allocation in a retirement complex is totally wrong. So I disagree with a lot of what you said. I don't think asset alternatives are wrong. I just think in retirement, they introduce a lot more uncertainty than people realize.
I don't want to monopolize time from Barbara and Rich, but all of this works on paper. Of course, we all know that diversification, lowers your risk and raises your risk-adjusted return. But that's not the point. It's about how this works in real life. But I'm going to stop. Rich and Barbara need a chance to talk.
I want to turn to Barbara because, Barbara, I know that you've looked at apps like Titan Invest. Should people, including retirees, be considering hedge funds, crypto, venture capital, private credit, et cetera?
Yeah, I've looked at a lot of the new crowdfunding type apps that open the door to alternative type investments to the little guy or the little gal. Now, some of them will require you to be an accredited investor, which is a little more wealthy, but some of them are open to anyone. And so my concern with the apps that democratize alternatives, as well as products such as Shana discusses, which are likely just available to accredited investors, and that includes hedge funds, those types of things, look at the fees, because fees are inversely correlated with returns. Research has shown that. And typically, hedge funds have huge fees, and many of these apps have huge fees. And so you need to be aware of that. That is my main point for now. I'm not saying good or bad, but whatever you invest in, know what you're investing in. Understand it. Shana, I get that, people can invest in alternatives, and people are not stupid, but they need to really have a good idea. What are the underlying products you're investing in, and what are the potential losses?
I want to ask Teresa, can you talk a little bit about this motivation for savings and what your research says?
Yeah, I've looked at wealth accumulation for the past 40 years to see if it's actually consumer debt that is causing the low amount of wealth, by the time you reach retirement. And it absolutely isn't. It's when we knock people out of the a retirement wealth accumulating institution like defined benefit plans, or what should have happened 40 years ago is a universal pension system that was professionally managed with pooled assets to exist alongside of Social Security, like all of our other sensible peers do. Then we would see actually wealth accumulate. The 401k has actually made retirement assets, that means all wealth assets, much more unequal. And so Shana is talking to a tiny sliver of individuals accumulating their retirement. They're at the very, very top. Perhaps they could take a spreadsheet and diversify and manage the cost and management manage the correlation. But if they want to do that, they should do it outside of tax favored retirement accounts, and just do it with their own money, not with the government's money. So it's not the fault of people's spending habits, our debt accumulation habits, that is causing the retirement crisis. It's inadequate system for accumulating wealth for the bottom. Really, it's actually the bottom 80% of the population just don't have the secure lives and the secure incomes, and the employers that have offered a retirement account.
Thank you. I'm so glad that we have a diversity of opinions here. Let's go straight to segment 2.